Texas Lutheran University.
I hope that you will all help me in welcoming Pat Dorsey today. Pat is a well-known expert on competitive moats and why one business has a sustained competitive advantage over others, and what differentiates those that allow them to compound at very high rates of return for not only a year or 2 years, but for decades on end. Pat's background is a bit unconventional, certainly didn't go up the route of University of Chicago, MBA type program. His undergraduate degree is actually in government from Wesleyan University on the East Coast. And bounced around, spent a little time in the retail brokerage business, ended up getting a master's degree in political science from Northwestern. And a short while after that, as Morningstar was rolling out their fledgling equity research program, Pat was pretty much employee number 1 or number 2 in that program. He spent 12 years there, 2000 to 2011. By the time he left, he had gone from being analyst number 1 to having more than 100 analysts working under him. The program had really taken off. Pat then got an opportunity to work for Sanibel Captiva, which is a private money manager down in Florida, manages more than $1 billion in assets. And Pat finally came to his senses and decided to start his own firm, Dorsey Asset Management, not too long ago. And so it's a smaller firm, but Pat's reputation certainly guides a lot of people in his direction. In addition to doing equity research when he was at Morningstar, he also kind of categorized, organized his research, and published 2 books as a result of that. One was titled Five Rules for Successful Stock Investing, and the other one from the Little Book series, The Little Book That Builds Wealth. And those are books that we use in our program, Bulldog Investment Company, on campus. They're good, common sense oriented books that anybody can read, but yet strong enough in terms of the intellect that goes into it to where professionals can really benefit a lot from it too. So Pat does call home Chicago, and I think he's probably happy to be in Texas for the next few days. So why don't we give him a warm Texas round of welcome.
I am happy. I had breakfast tacos this morning, something that Chicago has not managed to import yet. I would say it's probably Texas's contribution to global cuisine. Sadly, I don't believe it's barbecue because I'm a North Carolina barbecue fan, which we don't get in Chicago either. We get this kind of ketchupy glop that people actually call barbecue, but it's not really the real thing. Yeah, so Dave was telling me that he thought it might be useful, and I'll talk about this before I go into the speech about my background a little bit, just because my general message on this is, if I can figure this stuff out, you can. I have never had an accounting or finance course in my life. Went through the CFA program, banged my head against the wall, taught it to myself. But with the exposure y'all are getting to accounting and finance and practical investing through the Bulldog program, you are miles ahead of where I was at this point and where a lot of people are at this point. So every time you start thinking, man, this stinks, I can't figure this stuff out too hard, it's not. It's just not that bad. Because the interesting thing about finance is most people want to make it a lot harder than it really is. They want to throw a lot of crazy, ratios and numbers at you, and the guys on CNBC all act like they know far more than they actually do. But all you need to know about any business is, how does cash come in one end and go out the other end? And do I get my fair share of it? And then, what am I paying for my fair share of it? That's really all you need to know. And if you can figure that out, you can be a pretty good investor. So, I mean, it's just every time, if you think this stuff is daunting, we can, and I'll talk a little bit more at the end about just kind of general career stuff, because I came into this profession in a pretty unconventional way. And I would say that, having hired well over 100 people at Morningstar and interviewed God only knows how many more than that, our best analysts were the unconventional ones. Our best analysts were the ones who came at it from some interesting angle. and who loved it as a passion and weren't doing it just because it's what dad told them to do at 16. So talk a little bit more about that at the end, just kind of, kind of career stuff, because you all are probably interested in getting jobs at some point, I'd imagine. My first job at a college, I was doing research for a professor in DC. He was writing a book about the decision to drop the bomb on Hiroshima, kind of a very unconventional theory about what the reason was. And it wasn't to make the Japanese surrender, it was to basically show the Soviets what we had and they didn't. So I was basically digging around, decoding in old cables that had just been declassified in the Library of Congress. It was tons of fun, but I wasn't getting paid anything. And that was the problem. So I think you all are probably interested in the same thing, which is finding a job that you enjoy and that makes you money. And I'm very fortunate to figure that out. So what I want to talk a little bit about in terms of just the subject matter is competitive advantage. How companies are able to create what Warren Buffett calls, and at Morningstar we stole the term from him because if you're going to steal from the smartest guy around, an economic moat, a moat that protects the company from competition. We've done that, fine. My firm, we're about 80-odd million under management now, very concentrated. We only own about 13 stocks right now. It's a little bit more than I would like. I would rather get that number under 10 as we kind of do more work on businesses. Yes, it's frightening. It's even more frightening when you're pulling the trigger on it. This guy here, he's like, 13 stocks, oh my God. Do you guys remember the Memorex ad? When like the guy's sitting in the chair and the speakers are like blowing his hair back? That's kind of what he looked like. It's not live, it's a concentrated portfolio. We have a global mandate, so 11 of our 13 holdings are outside the US right now. We look around all over the world for businesses that have structural advantages, which is what I'll talk about today, the ability to compound at high rates over time, and hopefully talented capital allocators in the management team. So the basic genesis for all the work I did at Morningstar and the firm I run now is that capitalism works. It seeks the highest returns possible. High returns attract competition. If I wrote any one of you right now a $50 million check and said, go start a business, you would probably not say, I'd like to go into this horrible money-losing industry. You would say, I would like to compete with people who make money, right? High profits attract competition as surely as night follows day. However, most businesses high returns on capital, will see them decrease over time. Intuitively, this makes sense, right? If any of you smart folks are going to start a business, you're going to go compete with people who are making money, and you're going to drive returns on capital down. Empirically, this is also the case. If you take long longitudinal data sets of companies and say go at T1, companies in the highest decile of returns on capital, take the exact same cohort, run to T plus 10 years, T plus 15, T plus 20, they will almost always, on average, have lower returns on capital. Or let me rephrase that. They will always, on average, have lower returns on capital. However, averages don't tell you everything. Because we also know, empirically and intuitively, that a small minority of companies enjoy many years of high returns on capital. We can name a bunch of them off the top of our heads. J&J, Colgate, Budweiser, well, now AB InBev. There are companies that essentially defy the odds and manage to resist the pull of economic gravity for years, if not decades at a stretch. And they do this by creating economic moats, structural competitive advantages that make it difficult for other people to enter that business and reduce their profit pool. Because absent a moat, competition destroys excess returns. Period, end, full stop. Great technology is not a moat. A hot product is not a moat. Any of you guys remember Crocs? Okay? It's an injection molded piece of plastic. And if you're making an injection molded piece of plastic and earning a 30% margin on that, I will guarantee you somebody will compete with you. Because it ain't hard to do. And that's exactly what happened. Low-cost competition came in. No, they weren't quite as good as Crocs. People say, oh, they weren't as comfortable. They weren't kind of as sticky and grippy on the floor. They were half the price. Who cares? And so Crocs lost market share like you wouldn't believe. Absent a moat, competition always destroys excess returns. It is a law. So economic moats are their structural qualities. They're inherent to the business. It's not a hot product. Talked about Crocs. Remember Heelys? Anybody? Heelys? Whew. Aside from the product liability problems, which are huge, I'm not kidding. I mean, it's not small. And then schools started banning them. That's a problem. Again, you're sticking a wheel on a shoe. How hard is this? It's not a cool piece of technology. What one smart engineer can invent, another one can copy. And there are a lot of smart engineers in the world. So unless you have some other kind of technological moat, a switching cost, an industry standard, just having a cool blinky box that's better than the other blinky boxes, it's called a toaster, gang. That's all it is in time. It's not just the biggest market share. You hear CEOs all the time say, well, we're going for share. You hear that, run for the exit. Hit the sell button fast. That is danger. Some businesses, scale leads to more profitability. Most businesses, that is not true. GM, Compaq, biggest computer company, biggest car company, didn't do them a damn bit of good. That's a technical term, by the way. Because in auto manufacturing, your scale economies occur at the factory level. They don't occur at the firm level. So once your factory is running at 90-odd% capacity, if you got 10 of them or you got 30 of them, it doesn't make a huge difference. You make a little bit more savings in sourcing if you got 30 factories, not a lot. So being bigger does not matter. If you have a firm say they're going for share, ask them, why does this help you? Why is that a good thing? How does that make you more profitable? If it doesn't, it just means the CEO wants to get paid more. Because CEOs of bigger companies do get paid more than CEOs of smaller companies. That is true. And that is a strong incentive, especially in our country where CEOs are vastly overpaid, that they have an incentive to get bigger. So moats generally manifest themselves in pricing power. A company that can't raise prices does not have a strong moat. So if you have a company that's been raising prices and then one year, we kept prices flat this year, or our customers are having a tough time, so they pushed back and we reduced prices by 3%. Again, ding, 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 big warning sign. Companies don't cut price just to be nice. It doesn't work that way. Now there are some businesses, a very small minority, like AirAsia, Southwest, Costco is the best example, where they use price to drive out the competition, right? Costco will basically use volume to attract more customers, to drive down their purchasing cost, then drive down their price, and it's a circle, right? And so that is a very rare example where the moat allows them to lower price and thus expand share and develop that virtuous circle. But that's because their advantage is based on scale. If your advantage is not based on scale, cutting prices doesn't do anything for you. So what I want to do is talk quickly about kind of the 4 kinds of moats that we use as the foundation for our work at my firm and that we developed at Morningstar. To develop these, we went back from, I think it was 1952 or 3, when we had a data set from CRISP through, it was the late 90s when we did this, and basically said which companies have managed to produce returns on capital beating cost of capital for 15 years plus. And we just basically said, okay, because empirically, these are the ones who've done it, right? And so let's say, okay, what commonalities do these businesses share? Can we tease out some characteristics that we can then sort and categorize? And that's kind of, so it was very much an empirical exercise. We didn't say, well, competitive advantage should be that. It's, okay, what's worked in the market? What has actually generated competitive advantage? First one, intangible assets, brand, increasing willingness to pay or lowering search costs. Now, this is very important to remember, that a brand must lower search cost or increase willingness to pay, or it is worthless. And every cent spent on advertising is wasted. How many people in this room would pay 15% more for a Sony DVD player relative to one from Philips? Wow. Usually I get like 1 or 2 hands. That was a 0, okay? Yet, Sony is ranked as the top 15 most valuable brand in the world. I think we can all say that we've probably seen a Sony ad, right, somewhere, in the magazine, on TV in the past month. What ROI did that ad have? None, right? We just empirically demonstrated that you don't care. You don't care whether it's a Sony name or not. That's because a DVD is a commodity product. Let's roll back 20 years, when VCRs were brand new, you could get a little bit of a price premium on it. When the Walkman was brand new, you could get a little bit of a premium on it. But that quickly went away. Consumer electronics have very fast product cycles. The industry commoditizes, nothing. So I would argue that almost every cent Sony spends on advertising is completely wasted. Let's contrast that with Tiffany. Tiffany will charge you 20% more for the exact same diamond that you could buy from Blue Nile or Zales or Jared or Hellsberg or whomever. 20%. And a diamond is an objectively, you can quantify the 4 C's, cut, color, clarity. Is there there's a 5th C? It's been 12 years since I bought one. There's 4 C's. Okay, there's 4. There's a few married guys in the room. I saw a couple of Fords going. What? Good man, good man, good man. I heard you had an economics background. I imagine that would have helped. But see, right there, the blue box is not worth 20% more. The cardboard does not cost that much. I guarantee you. But the smile on the recipient's face might be that much bigger. Might be. And so Tiffany exploits that. So if you're looking at a business and they can't tell you, the brand does not change consumer behavior, it is not worth a damn thing. Amazon, same thing. How many of you have bought something off Amazon without checking the price elsewhere? Oh, admit it. Everyone's like, come on. That's like, what is that, like half, 2/3 the room? Now, that's an amazing statistic, isn't it? Like, what is the caloric cost of moving your mouse to another website? It's nothing, right? And yet, that Amazon brand matters. Okay, and this is important because I call this the why Jeff Bezos is much richer than Pat Dorsey lesson. He figured out very early that offline and online retailing are quite different. Offline, I give you money, you give me a product, our relationship is finished. There is no trust involved whatsoever. Online, I have to trust you. I have to trust you to not steal my credit card. I have to trust you to send me what I ordered. I have to trust you to send it to me when you promised it to me. I have to trust you to take it back if I want to give it back. Lots more trust involved. And that means the value of the brand is higher online than offline because it involves trust. And that's why we just saw for a whole bunch of you say, maybe it's not the very cheapest at Amazon, but I know it's close enough and they're easy to deal with. I trust them. That is a brand that changes your behavior. That's a valuable brand. Patents, second kind of intangible asset, very valuable, but patent lawyers drive nice cars, at least the ones that I've met, because patents are very valuable if you challenge them. If you challenge a patent, get it invalidated, you get paid a lot of money. And so there are always people challenging them, and so you build a moat by having lots of patents protecting your product. You have these firms like specialty pharma firms that might have 1 or 2 drugs, and that's all they got. Those patents go, so does the moat. So I would regard that as a very brittle kind of moat. Licenses and approvals. If you have the license to put a landfill in somewhere, run a casino, make aircraft parts, which are very heavily regulated, that's a valuable intangible asset because those are hard to get. When you're looking at intangible asset licenses, though, bear in mind that the folks who make the rules can also change the rules. And understanding regulatory and bureaucratic behavior is not the easiest thing. So you want to be real careful with what kind of regulatory environment you're operating in if you're relying on a license or approval. It's often good there to have what we call a backup moat. So let's say you have a license to have a landfill in a given area. Okay, you can try to just trust that the folks won't give out more licenses for landfills, but you got a backup moat because nobody wants a home near a landfill. And most municipalities are driven by property taxes. So they're not incented to give out tons and tons of landfill licenses, right? Once you got one, there's probably not a lot more that are going to be given out. Whereas casinos can be different. Basically, you give a casino license out, and then the state takes 40% of the revenue off the top. Ooh, that's pretty good. Let's give out some more of those. And then once you have the riverboat built somewhere, ooh, let's hike that from 40 to 60% because you're not going to move the riverboat, which is exactly what happens. So you kind of got to think about the incentives on both sides. Brands are valuable if they deliver a consistent or aspirational experience. Consistency lowers search costs and drives loyalty. You don't change and give people a reason to switch. We all remember New Coke, right? Further back than New Coke was what we call the Schlitz mistake. Schlitz, believe it or not, was the #2 brand in America for about 10 years. The #2 brand in America. So what did they do? They changed the recipe. Maybe one of the more moronic management decisions of all time. Basically, it caused flakes in the beer, and so Schlitz was called flaky beer because it literally had little flakes in it from the stabilizer when you poured it out. Lost market share in droves. Don't change if you're delivering a consistent experience. Aspiration increases willingness to pay, so you want to go for creativity, scarcity, and exclusivity. Here's a great one for you, Tiffany's store layout. How many of you, who's been inside a Tiffany's store? Again, I won't admit it. Okay, was the expensive stuff at the front or at the back? Oh, come on, let's just talk. I'm not going to bite. Was the expensive stuff in the front or in the back? In the front, right, okay. So now, here's an interesting stat for you. Tiffany makes about 30–40% of its sales from goods under 200 bucks. Now, if that's your high volume stuff, wouldn't you put that up front? No, because you messed with the brand. If you put the expensive stuff out front and make people walk past all the stuff they can't afford to get to the stuff they can afford, it increases the value of the brand. Brilliant, totally brilliant. Patek Philippe. This is the ad on the back of The Economist most months. You don't own a Patek Philippe, you merely take care of it for the next generation. Again, promoting exclusivity. It's a great, great trick. Now, aspirations differ. This is kind of a fun one, but I just thought I'd put it up here. So Jack Daniels. That says, happy birthday, Mr. Jack. And so and you can see it's the same kind of Jack Daniels marketing that we have in the US, right? Rough and tumble, the West, getting back to your roots, the countryside and the villages are a good thing. And this works for Russians because most Russians have dachas. They have homes outside the big cities. And it's a society that urbanized a long time ago. So there's kind of this back to your roots things works for them. Now look at that Jack Daniels ad and now look at this Jack Daniels ad. A little different, right? Now I have a decent Chinese translation of this, but it's always better if anyone here read Chinese and want to give me this one? Nobody? Okay, I've been a lot of times I have someone. Okay, basically what it says is, it doesn't matter. What drives success is not how you are; it's how you look. Basically, or sort of, it's image matters is the general. I'm getting this pretty wrong, but the general idea of this is image matters. And you've got this Jack Daniels bottle in a nice urban bar. It's slick, it's hip. Why? Because China's urbanized in the past 15 years. If you say, hey, drink this because it'll make you look like you're back on the farm, that's probably not going to say, spend a lot of money for this, right? It's not. And so, again, but here, this is smart marketing, right? This is a brand development firm, Jack Daniels is Brown-Forman, that understands that the brand is about aspiration, and they're promoting it, and that's what you'd want to see. Second kind of moat we look for, switching costs. Very simple. Does the cost of switching to a competing product outweigh the benefits? You see this a lot in software. Oracle, classic example, databases. A database is the heart of many companies. It is the engine that makes it go. And so if you guys started up the Texas Lutheran database and it was 20% faster and 20% cheaper than anything Oracle had ever made, and you go to P&G or Colgate and tried to sell it, you'd get laughed out of the room. Because it would cost P&G or Amazon or whomever literally tens of millions of dollars, if not hundreds of millions, to rip out one database and put in another one. It's at the fabric of the company. And so every year when Larry Ellison says, pay me more, people pay him more. Oracle raises prices about 2–3% every single year without fail, and the customers don't leave. Switching costs are an awesome, awesome moat, and you usually see them manifested in pricing power. You could also sell ongoing service relationships. Cohen and Schindler are elevator companies that compete with Otis, which is part of United Technologies. Now, elevators, they go in your building, and someone services them, and if you don't like the service contract, Do you rip out the elevator? Usually not. It kind of stays there in the building. So that service contract just kind of ratchets it up a little bit over time. Great switching cost. Or you can provide a product with a high benefit cost ratio. Good example here, Novozymes. They make very exciting enzymes. Doesn't sound exciting, but enzymes are why, like if you buy bread from the H-E-B or from the grocery store, and you buy bread from a bakery, this goes stale in a day. The one from the store is good after a week or whatever. It's because it has different enzymes in it that keep it fresher. Enzymes are what make beer ferment. Enzymes are what help yogurt set faster and culture faster. Again, tiny, tiny amount of cost that goes into the product, but increases the value to you, the consumer, very much. So if the enzyme manufacturer or the fastener or the lubricant manufacturer raises prices 10%, your overall input costs are going up 0.001%. Doesn't matter. But the benefit to the consumer is very high. I was talking with somebody before the talk about a company called Henkel, a German firm that makes adhesives. Very similar. So if you've got an adhesive that helps stick parts of your dashboard together, and let's say the automobile manufacturer decides that we're going to save money on the adhesive, right? We're going to go 20% cheaper on adhesive, and that's going to probably save like a nickel off the cost of the overall car, and then parts of the dashboard fall off in the Texas summer. Not a good consumer experience. Probably not worth saving the nickel or the quarter or even the dollar, right? So that delta between economic cost and consumer benefit is often an awesome switching cost. Network effect, and this is something that's more common now than it was more common for information firms. You provide a service that increases in value as the number of users expands. And this is kind of interesting to think about, because think about it. Like a restaurant, does the value of a restaurant increase for you if they have more customers? The value actually might decrease because you got to wait longer in line, right? Whereas, how many of you people in this room do not have a Visa, MasterCard, Amex, or Discover in their pocket right now? Exactly. 90% of America's credit card traffic goes through those 4 networks. Now you'd say these businesses should attract competition, right? MasterCard and Visa basically take a toll every time you swipe your card. There's no credit risk whatsoever, massive scale economics because they built out the network, and every bit of incremental revenue drops right down to the bottom line. Gee, 40% margins? No, sorry, Visa's 60% operating margin. That should attract competition, right? Well, let's imagine I gave you $100 million, which is really imagining because I don't have $100 million to give you, and you went out to try to start a new credit card. You would have to simultaneously convince hundreds of thousands of individuals and tens of thousands of merchants to use and accept the card. And neither one is going to do it before the other one does. The consumers don't want the card if they can't use it. The merchants don't want to accept it if nobody's got it in their pocket. This is why there has not been a new credit card company in America for about 30 years. And the network effect is an unbelievable moat. You see it also with distributors. When you connect fragmented groups of suppliers and customers. Dentists. Dentists tend to be single family, there's 2 or 3 dentists in a group, right? They don't work in giant hospitals. And they don't make their money by sitting around shopping for the very cheapest piece of gauze to stick in your mouth. They make their money by getting more patients through the door. So if you're Henry Schein, which is a dental distributor, you work with a whole bunch of folks who do gauze and all the different stuff that goes into a dentist's office, and then a whole bunch of dentists. Both groups are very fragmented, so you can extract economics from both sides. Distributors who occupy that position have awesome network effect moats. I talked about that nonlinearity of nodes versus connections. This is actually kind of a tricky thing, but it's fun to think about. A radial network, where basically you think that's a credit card, right? We're basically, or an auction platform where each node adds to the additional node. Each place you can use the credit card, each seller on eBay makes eBay more valuable to you. Very different than a radial network where you have corridors going out. And I think about this a lot because it was one of my bigger screw-ups. Western Union. Western Union, money transfer company, often talks about, we have the most number of branches in the world. And wow, that makes our network effect great. Okay, that's true. They do have the most number of branches in the world. But Nobody is sending money from Bangladesh to Mexico City. They're sending money from Bangladesh to Chicago and Chicago to Bangladesh. They're sending it from Chicago to Mexico City and back and forth. No one's sending money from India to Mexico City. Or, well, somebody is, but not many people are. So it's a corridor-based business. It's not a true network effect. And so you can basically get picked off along those corridors. You can have lower cost providers come in along those corridors. Very, very kind of fun point to think about when you're thinking about networks. Cost advantages, this is kind of B-School 101. Just invent a cheaper way to deliver a service or a product that can't be replicated quickly. The key here is to differentiate in terms of what kind of cost advantage you have. There are scale cost advantages, which are very durable. Think about UPS. What is the marginal cost of one more package going on a brown van and getting delivered? The marginal cost is nothing. So the marginal profit is quite high. So very difficult to compete. DHL, which is a large German owned by Deutsche Post express carrier, DHL lost $900 million trying to compete with UPS and FedEx in the US ground delivery market. And it's not because they're bad operators. They're great operators. They just couldn't build the scale up. They couldn't build that dense route distribution network. So that scale advantages can be very powerful. Process-based advantages, by contrast, again, let's go back to basic competitive theory. If it can be copied, it will be copied, right? If you can compete with it, you will. Dell no longer sells the cheapest computers out there. And also, and this is again one I got wrong, this whole thing is a lesson of how Pat screwed up his investing career. Because no, Dell, I totally got it wrong, because for a while they maintained their cost advantage, but cost advantage isn't as valuable when your ASP, your average selling price, keeps declining year after year, right? Think about it. Saving 20% on a $5,000 product, which is what PCs cost 10 years ago, you're saving $1,000. Man, I'll deal with Dell's crappy customer service for that. Now a desktop PC, $300, $350 maybe, at the low end, I'm saving $60. Do I really want to deal with Dell for $60? No, not really. Yes, I know they're based in Austin, but whatever. It's not as big an advantage. I mean, people have also closed the cost gap, but there, it's about the dollar cost versus the hassle, because it's on a percentage basis. Things get copied over time. Southwest. Southwest model took a long time, but people have copied it. Southwest no longer has the lowest cost per available seat mile in the US. Sorry, another Texas firm I'm trashing. I apologize for that. But the point is that these can all get copied. To copy UPS, you've got to have just as many brown vans running around the US. That's a lot harder to do. The third kind of cost advantage, which is really awesome if you can find it, is a niche, where you establish what's called minimum efficient scale. Basically, a market is small enough that it really will only support one or two players profitably. And so if a third player comes in, the profit pool comes down enough that nobody is making any money. So you see this a lot with like small software companies, where you might have, there's a great business called Constellation Software. You ever want to read a great shareholder letter? It's amazing. Started by a guy named Mark Leonard 28 years ago with a $25 million venture capital investment. It is now $10 billion in market cap, has never taken a cent of outside capital. Do that math. It's cool. And the way they've done this is by buying what are called VMS companies, vertical management software, where essentially the software companies that own a niche. For example, they have one of their software companies has 80% market share for ambulance dispatching software. So ambulance dispatchers that's pretty much what they use, because it integrates with 911 systems and hospitals and so forth. Another one of theirs, it has 80% share in golf country clubs, so managing people's greens fees and catering demands and stuff. Okay, I mean, who knew? But it's out there. And the point is, this is not a big enough market for Oracle or Microsoft or anybody to really go after. But while they're there, they own it, lock, stock, and barrel. If you can find these companies that just dominate this niche, they often can't grow very well, but man, they can spit out cash like you wouldn't believe. So what about management? I talked a little bit about this with a couple of you beforehand. There's an old quote from Buffett that good jockeys will do well on good horses, but not on broken down nags. So this is a professional jockey. He is on a goat. This is me on a horse. As long as I don't fall off, I will win that race. Not because he is an idiot, but because the goat is not as well suited to winning races as the thoroughbred. Some businesses are goats. Some businesses are thoroughbreds. And management can only deal with the hand it is dealt. Even the smartest management in the world, if it's riding a goat, can't win the race against a thoroughbred. It's simply not going to happen. So what the lesson here is get a good horse. Managers matter in the context of the moat. The required level of managerial skill is inversely related to the quality of the business. It is inversely related to the quality of the business. In plain English, what that means is, if it is a bad business, you had better have a great manager. This is Michael O'Leary, who runs Ryanair. Basically copied the Southwest model, ran it all over Europe, an unbelievable business. Airlines are the worst business in the world. You'd better have a good manager. Now, if it's a great business, genius is not needed. This is Steve Ballmer, for those of you who don't know. And he is describing what he has done to Microsoft's moat. Sorry. I gave this talk actually at the Googleplex last fall. It was great. They loved it. It was kind of shooting fish in a barrel. But seriously, I mean, Steve Ballmer spent 10 years with a blowtorch setting piles of money on fire every day. And Microsoft still had 30% operating margins because it was such a good business, he couldn't screw it up, even though he tried. And I'm not saying you want to find the great business run by Steve Ballmer. I mean, good luck with the Clippers, Steve. I hope that works out for you. Did he get the Clippers? Yeah. Okay, all right, good luck.
Another goat.
What? Yeah. Sports teams tend to, it's an ego stroke. They don't make you a lot of money, you know. Yeah, I don't know if the Clippers are, I don't follow basketball, but I kind of assume sports teams don't make money. And, I mean, look, dude, I come from a town with the Cubs and the Bears right now. I made a sports joke. God, that was cool. I've been trying for years. But seriously, this matters, right? And so if you're analyzing a business, you have kind of this pie. You have like a pie of time available to analyze that business. If it's an amazingly wonderful business, you don't need to spend as much time on management. You just need to make sure they're not complete idiots. You want to spend your time on the structural advantages. If it's not a very good business, mining, commodity, chemical, airlines, retailing, tough business, you want to spend a ton of time on management because management really, really matters a lot. So moats can buffer management mistakes. We talked about Microsoft, and they minted money despite, not because of, Steve Ballmer. New Coke didn't kill Coca-Cola. Moody's, great one. Put profits before integrity. Basically lied to people. And let's call it what it is. And still cranked out a 40% operating margin. Because it's part of the financial plumbing, it couldn't go away. But even a genius like David Neeleman couldn't change the fact that JetBlue is the worst business in the world. It's an airline. Anybody remember when JetBlue went public? 40 times earnings. Ooh, they have leather seats. Ooh, they have satellite TV on the back. How hard is it to copy that? An airline will never have a lower cost structure than the day it opens for business. Why? The planes don't get newer, they get older and require more maintenance. The staff, the ramp workers, the pilots, the stewards, they get more seniority and ask for more money. Cost has to go up over time. And you have a seemingly insatiable, an unlimited supply of idiots willing to start airlines. And so when your costs have gone up, somebody will show up, buy new planes, come in and undercut you. I don't know, it's like buying sports teams. There's an old joke that, how do you make a small fortune? And start with a big fortune and buy a sports team. Same joke applies to airlines and wineries too, I think. Good managers are constantly looking for ways to widen a company's moat. We talked about Amazon. They're focused on the customer experience. That is all they're focused on, is how is your experience as a customer? It is what drives everything they do. Costco's focus, which we talked about earlier, using scale to lower costs. Bad managers invest capital outside a company's moat, which lowers overall returns on capital. This is called diversification or setting fire to large piles of cash. Okay? He is investing outside his moat. You know, I tried to put like a Steve Ballmer face on him, but my Photoshop skills are not good enough. I also thought I might get sued. Now, all this said, there is an exception to every rule, okay? And this is a lesson here in take everything I am saying with a grain of salt, filter it through your own critical analysis, okay? A tiny minority of managers can create enormous value via astute capital allocation, even if they don't start with great horses. Buffett started with a textile mill. Not a good business. Brian Joffe, Bidvest in South Africa, built an amazing firm starting with basically one container ship. Dick Kovacevic at Wells Fargo. Banking is a tough business. Amazing what Dick did at Wells Fargo. Stephen Mitch Rales at Danaher. Turned a bunch of crappy industrial businesses into a company that it basically has beaten Berkshire Hathaway most rolling 10-year periods for return. These guys are hard to find, and women are hard to find. False positives abound, but they create enormous wealth over time. Keep an eye out for them. Don't doubt that they exist. Okay? If you assume they don't exist, you basically assume Berkshire could have never existed. There is a tiny minority of what you might call 3 sigma managers out there. If you're really interested in pursuing this further, there was a great book last year called The Outsiders that I would highly, highly recommend. Probably the best business book I've read in the past 5 years. That talks about a bunch of unconventional CEOs. Bill Stieritz at Post, John Malone at Liberty, and so forth. They're out there. Generally speaking, business beats management, but there are a small number of managers that blow that rule up. Let's talk a little bit about moats in a global context. We are a global firm. I think it matters as you think about the world outside the US. We're a huge country. We're big, but we're only half the world's market cap. German car washes. Here's a good example. In Germany, you can't wash your car in the street. I'm not joking about this. I thought this was like a German was like just totally like yanking my chain when he told me. It's true. Most German municipalities, they're too worried about the chemicals and detergents getting in the water. You can't wash your car in your driveway or on the street. So there are a lot more car washes in Germany than there are here, because that's the only place you can go. So there's a great little business called WashTech that basically refills all the consumables in car washes. The soap, the brushes, everything. Root density, beautiful little business. It would never work in the US. A, because people don't wash their cars as much. B, because you've got competition from washing it yourself. And C, because we're not as small a country as Germany, so you can't get the root density. This business could only exist in Germany. But the reason I bring this up is you can't, if you hear about something like, that would never work here, well, here is not there. I mean, I'm actually, one of my analysts right now, I keep pounding him on the head, like, not every country looks like the US. And so these local differences can really create moats. Minimum efficient scale is more common. In the US, retailing is a tough, tough business because we're a huge market, lots of capital comes in, it's really hard to create scale. In South Africa, in Australia, all the retailers look like Costco. I swear, if I gave you their returns, you would say, what is this business? It is not a retailer. And the reason is very simple. Who's going to bother putting money in South Africa or Australia? It's just not that big a market, right? And so you get 2 or 3 firms that just dominate the place. It's incredible, minimum efficient scale. Beck World, this is a great example. So Thai language media, they basically own Thai language media in the same way that Televisa Univision owns Spanish language media. So soap operas, news broadcasts, everything in Thailand runs through these guys. We took a look at it. We were so close to buying it, but then like the guy who owns it is part of a family that's tied into the Thai political structure, which if you've ever, is Byzantine to say the least. And so we figured it was too hard for us. But I mean, lots and lots of people are going to make shows in English. Not so many in Thai. Or Portuguese. That's Globo in Brazil. Cultural preferences also create barriers to entry. Beer travels, right? You've all had a Corona at some point. Bud does an okay job selling outside the US, even though it's pretty bad. Sorry. Candy and snacks don't. A Brit you would have to force feed them Hershey's. Just, they're Cadbury people all the way. Here, Hershey's. I mean, do you ever see Cadbury except for the cream eggs at Easter? You never see it, right? The things that we develop an affinity for early in our life, I mean, hopefully, which is hopefully not beer, hopefully that's later in your life, I hope. Candy and snacks don't travel well. There are tons and tons of the Calbee is basically the Frito-Lay of Japan. And they have all these amazing snack products in Japan that just will not travel outside of Japan. Hershey's does not travel outside the US. Beer nuts don't travel, no, they do travel because you eat those later in life. But, so those are just cultural preferences. They create huge barriers to entry. So why does any of this matter? Why bother thinking about moats? They add intrinsic value. Because a company that can compound cash flow for a lot of years is worth more to me today in intrinsic value firms than a firm that can't. My one bit of cool animation. The wide moat company, you start with a high return on capital, takes a long time to come down to cost of capital. The no moat business, competition shows up real soon, drives returns down. And so you have more time to reinvest cash back in the business at a high rate of return and compound capital. It is logically, mathematically, and empirically sensible to pay more for a business with a moat that can reinvest than one without a moat. Not infinitely more, but somewhat more. Now the value, and this is another critically important point, it's largely dependent on reinvestment opportunities. If you can reinvest cash at a high incremental return on capital, you have an insanely valuable moat. Curo is a firm that we own a piece via a holding company that is the largest provider of private education, secondary and primary, in South Africa. It's a beautiful business because South Africa basically, the only schools they're building are in townships to basically make up for the apartheid days because there so few schools were being built in poor areas. And so now, if you're a middle-class South African, white or black, doesn't matter, you are getting 20,000 home developments with no state school being built there. Whoop, that's a pretty good business. And so the runway is just as far as the eye can see, especially because, a school basically it's like a hotel. Your first 85% covers your costs, and then your next 15 students are pure profit, at sort of at a secondary and primary level. So enormously valuable business. The moat is very valuable. Now, if you have limited ability to invest, the moat, it adds certainty, it adds confidence, doesn't add much to intrinsic value. McCormick, great example. McCormick owns spices in the US. When you go to that rack and you're like, I have to pay $10 for turmeric? Seriously, it's painful, right? Even the private label there, that's owned by McCormick too. Amazing. But the amount of turmeric consumption is not increasing by 20% next year. Cardamom, maybe, not turmeric. The volume is not increasing. Obviously, nobody cooks here. Because this business is not growing, they can't reinvest back in it. They have to pay out the cash. And so the moat adds certainty, it adds confidence around your fair value estimate. Doesn't mean you want to pay 30x, 20, 40x for the business, because they can't reinvest back in. It's when you can reinvest that the moat adds a lot of value. Moats are also not inevitable, and partially because of the influence of that dude in Omaha. Everybody's thinking that moats are limited to these super stable businesses, the Krafts, the Heinzes, that our grandkids can own. Those are not the only moats out there. There's plenty of moats in businesses, in technology, in distribution, and other areas. Moaty businesses that pay cash are good, but ones that can reinvest cash are, technical term, totally awesome. Those are the ones that really are going to make money over time. So the last big point I want to make is that overestimating the moat causes you to pay for value creation that may never materialize. Underestimating the moat means paying a very large opportunity cost. So this is real cost, Motorola. Anybody remember the Razor? Okay. How many people here had a Razor at some point? How many people here have a Motorola phone now? One. Okay, there is one. I got one. All right. Now, okay, so you've just empirically proven my point. The Razor is released. Motorola gets a 22% market share because of this cool little slim phone. And the market basically prices in a non-existent moat because it's just hardware. There's no switching cost whatsoever. The next cool phone comes along, whoop, let's get rid of that one, as you all did, as I can see. And new phones come in, moat has 10% market share. That's overestimating the moat. You overpay for value imputed in the stock, and you lose a lot of money. Now the flip side is opportunity cost. This is Walmart from 95 to 04. And this is a story that Buffett told at the 02 annual meeting. He said that Berkshire set out to buy several million shares of Walmart at around 95 or 96. They bought a little. The price moved up a bit. And he said, hey, Charlie, the price moved up an eighth. Moved up a little. Let's wait a bit. Thumb sucking on Walmart, direct quote, cost Berkshire $8 billion in profits they could have made if they just paid up a little bit and said this is a wonderful business, not just a good retailer, but a truly wonderful compounding business. That's opportunity cost. And that's the real cost of not truly understanding the competitive dynamics of the business. Most investors spend tons of time on margin of safety, little time on opportunity cost. If you're a deep value investor, you should spend time on margin of safety. That's what you do. But if you're going to think about moats, if you're going to think about compounders and do all that work, capitalize on it. Think hard about opportunity cost. The moat is not always priced in because most investors own securities for a short time. Moats matter in the long run. Most investors also assume the current state of the world persists longer than it usually does. And most investors focus on short-term changes in price, not long-term changes in moats. The average turnover for a US equity mutual fund is 110%. That means the average holding period for a stock in a US mutual fund is about 10 months. Moats don't matter over 10 months. Moats matter over years for compounding purposes. And this is why I firmly think that finding moats means finding an efficiency. Quantitative data is efficiently priced. It's in a Bloomberg, it's in FactSet. There's tons of physics PhDs on Wall Street scraping every bit of data possible, trying to find a better way to manipulate it and to get a trading strategy out. It's efficiently priced. Qualitative insight is much, much less efficiently priced because it takes work, because it takes time to understand the dynamics of the business. It means getting out of your office, talking to suppliers, talking to customers, understanding how an industry functions. And so it tends to be less efficiently priced by the market, I've found. Great quote from Bill Miller. All of the information is in the past, but all of the value is in the future. That's where understanding competitive dynamics, I think, really aids in security selection and stock picking, because it's those competitive dynamics that drive future value as opposed to just looking backwards at past financials and extrapolating them out. Thanks. I'm here all week. Try the veal. So, you know, anything you got. Oh, actually, I'm going to real quickly, because I know this is going to come up and I'm going to head it off at the pass. The Motorola example, some bright person in this crowd is going, oh, what about Apple? Isn't that going to happen to Apple? No. Software. That's the reason. Motorola, the OS stunk. Does anybody remember the Motorola operating system? It was horrible. Nobody wanted it. It didn't integrate with any part of your life. People bought the Razr because it was cool looking, right? Now, do you buy an iPhone because it's cool looking or because it does lots of cool stuff? Probably because it does lots of cool stuff, right? People tend to not switch out of the iOS ecosystem. Apple has been losing some share, but that's largely because people buying smartphones for the first time are often buying lower priced Android phones. And that's a risk for Apple, staying up at the premium end of the market. But people, once they're locked into the iOS, actually, I got a good audience here. Okay, how many of you, please be honest with this one, okay? You guys were a little reluctant before. You got to be honest on this one. How many of you have switched from iOS to the Android ecosystem? Okay, so 1, 2, 3, 4, 5, 6, 7, 8. About 8 have switched from iOS to Android. How many have switched from Android to iOS? Thank you. No, I'm serious. I mean, this is real, right? Right here, we just saw it. The switching costs are higher. So anyway, please, yeah, question right there. Go ahead. Dave, can we get this guy out of the room? I mean, I've already talked about my mistakes enough. Come on.
I was just wondering if you had like your biggest one or
My biggest one, okay.
one, if you don't mind sharing.
I drive down to Seguin, and I'm going to. This is Texas hospitality. Come on, guys. No, seriously. Is it Seguin? Is that how you pronounce it? Okay, sorry. I thought I caught that from somebody. I would not have known it from the spelling. So a couple omission, a couple commission. Amazon was a huge one for me. Huge. Just huge. Because I was caught up in this idea that online retail would be commoditized. You had search engines, you had, searching for the cheapest price everywhere else, and I completely did not get the offline-online trust point and the service. I just right over my head. And then I had an opportunity, and that was sort of early on. And Amazon got down to like $12 a share, $10 a share. There's this analyst called Ravi Surya who was a bond analyst and said they were going to go bankrupt, which was complete crud, but it drove the stock down a lot. This was like 01, 02, when anything connected to the internet was just toxic waste. And I remember I was in New York, and there was a debate between Bill Miller, kind of a new school value investor, and a guy named Bruce Greenwald, very much an old school value guy. Very much kind of a, mano a mano kind of thing. And I remember I vividly remember this. Verbatim, he said, "There is nothing in my portfolio I would not sell today to buy more Amazon at $12 a share." What did I do? Nothing. Come on, dude. That was a biggie for me. I should have been there. I should have been there. MasterCard, we got pretty right at Morningstar, but we didn't see the runway on it. We came out at 40, and we had a fair value of like 110, which we thought was nuts at the time, but that was too low. That was way too low. So we kind of got that. We got that one wrong, and then Western Union, we really screwed up. Not really. That was sort of where that kind of radial interactive thing came from. Is that, and I also remember I mentioned about pricing earlier. I still remember, when we were sort of initiating on Western Union and we had put a wide moat rating on it. And I remember one of my more skeptical analysts, who was smarter than I was, said, "I've never seen a wide moat business that lowers price every year, except Costco." And because Western Union's theory was they cut price every year to drive other people out of the market, right, and to increase scale and whatever. That wasn't the case. They were doing it because you kept having lots of different startups in these different little corridors that they had to compete with. I just totally missed that dynamic. Yep.
So you really mentioned two aspects that as an analyst you're looking for that create value, create moats. The business, but there are some very small subset of managers that can do
Yeah. Yep.
What are you looking for most? Are you looking for the business, or and which is easier to identify? So really two questions.
Oh,
Are
sure.
you looking for business or manager? And
Well,
which is easier to identify?
the business moats are way easier to identify than the managers, than the Three Sigma managers. Way easier. Frankly, moats are. I've looked at 3,000. You figure after a while it's pattern recognition, right? Finding them cheap is hard, but moaty businesses are not that hard to find. Finding them cheap is much harder. Finding the Three Sigma guys, the guys who just have something special that enables them to take very little and create something out of it, those are really hard. And now what we look for there are, you typically need some kind of a track record, right? Like the guy who just sort of shows up and says, "Hi, I'm going to buy lots of businesses and do great with it." That's a little scary. But the wonderful thing is the market tends to be so skeptical of these guys for so long, you can look for track records and still get in at pretty good prices, truly. People for years and years would only buy like Berkshire below book value, as if Buffett had no value whatsoever. Does that make sense? No, not very much. So there's a company we own right now called Aurelius, It's a German company that buys unwanted assets from large European corporates. European companies are about 20 years behind the US in terms of spinning off stuff they shouldn't own. Like Linde, which is a huge German air products firm, still has a vineyard in the Rhine. I'm not joking. They use it for corporate retreats. Come on, guys. You know, I mean, up until a few years ago, Deutsche Post owned a hotel chain. I am not making this up. Really. Dirk Marcus, he's about my age, but he's been running Aurelius for about 10 years. But up until a few months ago, you could buy the portfolio at NAV. You were getting no value for his turnaround team, no value for his sourcing network, no value for the 15 years of connections across Germany and Europe he'd made to source these deals. Marketplace, no value on that whatsoever. So you can, I think a lot of times, look for this track record, but then the question becomes, what do you pay for it, right? And I think what we try to do is break it into two parts. What is the value of what they own today? And then what's the value of what we call the machine? What's the value of future capital allocation? And that requires some assumptions, right? I mean, you have to say, okay, how much capital will they allocate over a rolling 2-3 year period? What returns will they generate on that? And what's that worth to me today? Now, those are assumptions, right? And I read a lot of sell-side reports that say, oh, we don't forecast acquisitions. So there's a company called Roper that we own based in Sarasota, one of the leanest corporate structures I've ever seen aside from Buffett. 40 people at headquarters, $14 billion company. They've built the business by buying and improving other companies. That's what they've done for 15 years. And they've publicly said, we will deploy somewhere between $1 billion and $2 billion over the next 2 years, depending on the opportunities. I have seen not one sell-side report that bakes that into the valuation. Every single one just says, oh, we can't forecast acquisitions, even though the company is telling you they're going to do them, and they've created enormous value doing it. So those, again, they're hard to find.
So you have made purchases based upon the manager, not the business?
Oh, dear God, yes. And I would say that's probably 5. Out of our 13 positions, probably 5 fall in that category. And I think some of that is kind of where the market is now. It's just after 5 years going up, it's harder to find good values unless you kind of go really off the beaten path into these businesses that Wall Street has a hard time valuing because of the aspects we just discussed. Because they have to value future value creation. They're not pure management bets. It's not like give me the money. And they have to have a clear strategy. They have to have a good process. Companies that do M&A well, they treat it like investing, right? There's a process behind it. They think about how they do it, what their hurdles are. They do postmortems on what worked and what didn't. And there's a clear reason why they do each deal. Where M&A gets a bad name is the companies that do it every few years because some bright dude in the C-suite says, this part of my business is not doing well and I can cover it up by buying that thing, right? HP, anybody? Compaq, anybody? I mean, the list goes on, right? That's where M&A gets a bad name from. But when you're doing, with your ITW, Danaher, Middleby, Actuant, Roper, there's a big list of companies that they do this well because they think about it carefully. And it's an iterative process that they get better at over time. I was talking to somebody before this about macro and why it's so hard to get macro right. And part of that's because there's like 2 or 3 big macro turning points in a decade, and so you don't have a chance to iterate and learn, right? It's not like we have, we don't have a recession every 6 months, thank God. We don't have a recession every 6 months to learn from, right? But we can make investment decisions every few minutes. Anyway, you kind of see where I'm going. I'm rambling now, sorry. Yes, sir.
Most of your holdings are outside of the U.S., you said, and you also said you have an analyst who I assume grew up in the U.S. and applies his experiences, like you said, to
the filter, yeah.
Outside the U.S. in those situations. Without sending that analyst to travel around the world for a year, how do you fix that?
Yeah, that's a great question. I'm struggling with that right now. He and I talked about it. I think the biggest thing, Buffett has a phrase that he calls your mental database. And I think part of it is just making sure that you fill your mental database with companies that aren't just based in the US. Read annual reports that, for companies that are based in Germany, based in the UK, based in Australia, based in South Africa, based in Indonesia, whatever. Just look at them and see how are they similar, how are they different. I mean, that's the biggest part of it, right? Is just get those examples in your head. Because it's not so much about like living on the ground and saying, oh, these people like this kind of food and they don't like that kind of food. Because consumer taste is really hard. I mean, like we will never own like a real sort of consumer-driven business outside the U.S. because it's just going to be too hard for us to figure out. Like you guys all know Sephora probably, like the cosmetic chain. So there's a company called Sasa, based in Hong Kong. That's essentially the Sasa of Southeast Asia. That's a Sephora of Southeast Asia. Massive sales per square foot. They sell high-end Korean and Japanese cosmetics to Chinese tourists and to inside China. Phenomenal business. But it's consumer taste driven, you know? I mean, realistically, we might be able to get over there and visit companies like twice a year, you know, maybe. And so if somebody was opening up competing stores, if they didn't have a good product selection, if the brands weren't selling well, how would we know from Chicago? We would never know. So that just kind of has to go in the bucket. But we own a core banking software provider in Singapore, Silver Lake Axis, and core banking software is core banking software. And it's the engine that makes the bank go. You know, Jack Henry in the US does this. It's a firm called Temenos in Switzerland. FIS, Fidelity Information Services, does a lot of this. There's other companies you could look at to understand the business model. And the switching costs are pretty intuitive. If it's the engine that makes the bank go, and if it doesn't work, you process deposits wrong, and people get the wrong amounts on their statement, that's a problem, right? And so the odds that you switch based on a whim are pretty low. Like, I don't need to live in Singapore to figure this out. So that's one that I can do from here. Not so much. So yeah, I would say just read. I mean, the wonderful thing is that, you know, this is really over the past decade, every company of any size outside the US you look at is going to report in IFRS. And in many ways, IFRS might be better than GAAP in a lot of ways. But the point is, it's at least a standard. So, you know, it's not that different than GAAP. So it's not like you have to figure out tons and tons of local. You'll have to learn little things. Like in some countries, instead of saying revenue, they say turnover. Instead of saying leverage, they say gearing. Whatever. You know, it takes a little while, but it's not that hard. You know, a lot of them are, I mean, English is pretty common. You know, most companies of any size, even, it's not so much in Asia. Not so much in Asia. But certainly in Latin America, certainly in Europe, even in, you know, not in France and Germany, you'll get an annual report in English and in financial statements. It's totally doable. Yes, sir.
So, in your recent talk at Google, you mentioned the inefficiency with the operational leverage. The market doesn't understand the
operating. Yeah, sure.
inefficiency doing that. Could you walk us through like one of your investment you made with the operational leverage?
Yeah. So the question, just for those of you who didn't hear it, is operating leverage tends to be one of the most misanalyzed because, you know, people like to forecast in a straight line, right? Margins are going from 10 to 12 to 15 and it looks nice and pretty. Business is not pretty. It's lumpy and nasty. And so typically operating leverage or deleverage gets underestimated, right? You see deleverage like in retailers a lot, for example, you know, because it costs a certain amount for rent to keep the store open. You have a certain number of staff that you kind of have to have around. You can cut their hours some, but past that minimum cost point, if your comp sales start going down, your margins just crater. And I mean, your margins can go from 12 to 6 in a year. People don't typically forecast that, right? MasterCard, we initiated on it. You know, I mean, my analyst was like, this thing's worth 100, 110 bucks a share. IPO price talk was 40. I'm like, Mike, I'm not publishing this. You're nuts. He was like, no, I'm not. And he's walked me through it. And the way you figure it out, I think, is don't forecast in percentages. That's the biggest danger you can make. Because percentages, you anchor on those percentages. You want them to be nice and linear, right? But a percentage is an output. It's not an input. What you want to do is think about fixed versus variable cost. Okay? What is the fixed cost? And then how many variable dollars do I need to spend to generate an incremental dollar of sales? Just put that in and then see where the margins fall out from there. You will get probably lumpy numbers, but you'll probably be closer to that reality.
So,
He's not convinced.
No, my question is to get that will be during the initial phase of the company, right? I mean, you said MasterCard, that was during IPO.
Yeah.
But can this happen, like, let's say, can this happen after the company is there for a while? Like,
Well, it depends on new markets. So I mean, so right now we're doing a lot of work on a company called Coca-Cola Isicek that has the Coke bottling franchise in Turkey, most of Central Asia, Pakistan, and Iraq. They just consolidated the Pakistani and Iraq franchises a couple of years ago. Market share has gone from 28 to low 30s. No, 38 end of last year. But they're still building out the distribution networks. They're still building out these distribution networks. They've taken the number of distributors, independent distributors in Pakistan from 800 to 500. Enormous savings. Because all these distributors, they were all doing all the Coke product in each plant, which is unbelievably inefficient. What you want to do is you do Sprite in this plant and Coke in this plant, and you kind of move it around a bit. And then you just ship, because that way you don't have to do a changeover inside the plant. Much more efficient. So this is a business that's been around for a while, but there's still plenty of operational leverage left to go, because you're just reinvesting in the business. I mean, retailers, because same-store sales will fluctuate so much, if you don't really think about fixed versus variable, you'll never really understand how a change in same-store sales up or down will lever or delever a retailer's margins. Yes, sir.
Like borrowed a lot from Buffett, and then do a similar style. What's your holding period? Because when we talk about Buffett buying, it used to it's also on Coke and IBM for decades and decades.
IBM. Right. So the question here is sort of holding period, and we're kind of back to a mention of the guy in Omaha again. I would say, I said the same thing about what I'm saying. I'm saying the same thing. Don't take what Buffett says as gospel. Don't take what I say as gospel. Okay. What Buffett does works for Buffett. Buffett is managing $150 billion, or whatever the hell Berkshire is right now. So his holding period has to be forever, okay? And he has to buy, giant mega cap inevitables, because he can't buy smaller stuff, right? It wouldn't move the needle. That doesn't mean you have to. That doesn't mean I have to. Our holding period, it's certainly not going to be forever. I would say if we can get our holding period on average, let's roll the clock forward 20 years. And if our holding period on average is sort of 5+, I'd be pretty happy. I'd like it to be lower than that, but the reality is we're buying somewhat smaller businesses, often in emerging markets. Just things aren't quite as steady as Heinz. The businesses should return more, I hope, if I'm right. But that means also things will change, and that means either businesses will get too expensive, and then you got to swap them out for better opportunity. Moats will change. And so you've got to kind of reassess the competitive landscape. But the overall point here is that you do what works for you. If you find that you're the world's best day trader, day trade your heart out. I think that's a pretty hard way to make money myself. But if you figure out you've got a real good skill at basically capturing the spread and figuring out charts, there's nothing evil, wrong, or satanic about it. It's just not how I choose to do it. So you find what works for you as an investor, what sort of jives with your personality. And whether it's Buffett or me or anybody, all we're doing is saying what's worked for us. It doesn't mean that it's going to work for you. It doesn't mean it's going to work in every situation. I think you haven't had a question yet. Yep.
So what would you say is the biggest threat to a moat? Be it like debt or incompetence in management or anything like that?
And so the question is sort of what's the biggest threat to a moat? Well, it really just depends on what the moat is. It's kind of hard to generalize. If it's a brand, the product can commoditize. Management can change the recipe, as we talked about before. They can overexpose. So Tommy Hilfiger, great example. Tommy Hilfiger used to be kind of a very high-end, kind of preppy kind of brand back 15 years ago. And then they basically just blew it out in every department store going. Everywhere you went, it was Tommy Hilfiger everywhere. And so to clear the shelves, they had to discount the heck out of it. Now, when you have this thing that was once really expensive and you're constantly seeing it on the 50% off rack, ding, 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 that brand is getting impaired, right? And so that's a management mistake, but they impair the value of the brand. Companies with high switching costs often don't innovate well because they're too concerned with protecting their own franchise, right? I would argue that QuickBooks from Intuit has become just utterly impossible to use. I loathe QuickBooks. And there's a company called Xero, Xero, from New Zealand, that basically has pretty much destroyed them in Australia. They're moving them into the UK now, and they're coming to the US. It's available in the US. But it's a completely cloud-based, much more user-friendly. And a lot of that's because Intuit spent too much time listening to a relatively small number of power users, accountants, who would never let it change a certain feature, even though that feature could be done better or could be changed in a way that's more useful to many more people. But they had a very vocal minority of power users who were like, you can't ever change that. That's a problem. So I mean, I can't, it's hard for me to generalize. But one way to get at this, I mean, first of all, you want to always step in the customer's shoes, right? I mean, the best way to understand a moat is get in the customer's shoes. Look at the product from a customer perspective. Why do people use it? Why do they find value in it? Why are they okay with paying more each year if in fact they do? The company may have some version of that, but you will never get the truth until you actually talk to the users of the product. And that's often where these changes in competitive dynamics are most evident, because the company will paper over them for as long as possible. What you really find out is talking to users and seeing kind of where the customer experience is changing. There in the back, yep.
Like you said before, like you gotta make sure you know what the customer wants and what they're expecting and everything. And how do you like put that into a moat and stay ahead of what the customer wants? Like how can you tell that that's gonna happen?
So again, it's harder to generalize. So for consumer businesses where it's based on, say, fashion trends or something, super difficult. I mean, Mickey Drexler did an amazing job with this at Gap. Abercrombie did it well for many years until the guy basically went insane, as far as I can tell. But fashion generally is fickle. I mean, although it does vary. You've got brands, whether it's Gucci or LVMH or Dior, that have stayed very strong for many, many years because of that exclusivity that's associated with them. Brands kind of in that middle are a lot harder, I think. So there's a great book. How many of you have heard of a book called Clayton Christensen? What? The Innovator's Dilemma? So what this book is basically about is sort of companies that listen too much to what their customers want now and not what they might want next year in the future. And so they're concerned that they don't want to disrupt their existing business by moving to it. This is why, for example, here's a good example. So the Southwest model has been obvious for many years, right? Fly the same kind of plane, go point to point, have your crew clean the plane, all this kind of, turn it fast, yada, yada. I mean, it's no secret, it's been out there for years. And so you ask yourself, why didn't American or United or someone copy that, very early on? And the reason is they would have had to blow up their own business to do so, right? They would have had to take, well-paid, unionized flight attendants and say, hey, you're cleaning the plane now. Oh, that's going to go over real well, right? They would have had to tell, business passengers, oh, we don't have first class anymore. Oh, that's going to go over real well. They had a fleet of lots of different kinds of planes. They would have had to sell half of them and to standardize. Same thing with Compaq and Dell. Compaq sold most of its computers from what are called VARs, value-added resellers. That was their distribution channel. So when Dell showed up and went direct, Compaq would have had to blow up its business model. Would have had to say, hey, all you guys who've been selling our product and you're the only way we can sell it, you don't matter anymore. We're going to talk to the customers ourselves. That's going to go over. You know what I mean? See what I mean? Like that's so. But companies that are willing to do that, that are willing to think to take short-term pain for long-term gain, that's where you get some of it. So Autodesk, so Autodesk, any engineers here? No engineers, okay. Autodesk is basically the Excel for engineers. Might be the best. I mean, if you're doing computer-aided design, you're going to use Autodesk for industrial engineering. They were on a license model for many years. So you would have, Autodesk V 3.0, and then 4 years later, you would have V whatever, 2.0 or 4.0, whatever. And the problem with that is it's very lumpy. And so people hear there's a new version coming out, they stop buying the software, right? Because they want to wait until the new one comes out. So these very lumpy results. It's really, really a hard business. So they move to a subscription model, right? Where basically you're paying a small amount each month, and it's in the cloud, and it gets updated frequently, kind of like Office 365. Now the problem with that is what you pay per month is way less than what you'd pay for this license. And so you have to take this hit for 2 years to your earnings, and just crush your earnings for a higher long-term value. And see, that's the kind of behavior you'd want to see. And I don't know if that really answers the question, but you're sort of, that's kind of getting ahead of things, where you're sort of willing to think about where do you want your business to be in 5 years, not where do you want it to be next quarter. That's death. Yeah, you, sure.
You briefly kind of touched on your background. When you're looking to hire somebody in this business, what are like the main things you look for?
Yep. So question was just when we hire people, what are we looking for? And so I'll talk about, what we're looking for at my firm is a little different because we're tiny. But I'll talk generalized a bit Morningstar and sort of being an analyst in general. What I would say is focus on insight, not information. A 40-page PowerPoint deck is not necessarily better than a 10-page one. I still remember, because when we hired Bill at Morningstar, we'd always make him do a stock pitch. And one guy had a pretty decent pitch for Bud. It was before AB InBev. But he had like 10 pages on what Bud does. Dude, I know what Anheuser-Busch does, okay? Come on, don't waste my time. The thing is, what is your insight here, dude? Like, what are you seeing about this business that's different than everybody else is seeing? What's your edge? What's your angle? What is your, point of view that's different? And that's what I mean by insight. Insight makes money in this business. Information costs money. That's pretty good. I should think of that down. I'm serious, but insight is what makes you money. And so focus on insight, not information, when you're kind of trying to pitch to a potential employer. Focus on widening your mental database, understanding lots of different business models, right? How do software companies operate in terms whether it's license versus subscription? How do industrial companies manage capacity utilization at a different plant, and how that affects kind of the fixed cost versus variable cost at the plant level? You can't keep going on. You just kind of want to widen your mental database. And one of the best ways to do that is shareholder letters. I think shareholder letters are the most underutilized resource in finance. Think about it. If you wanted to play pro basketball, what would you pay for an hour with, I would say Michael Jordan, but I'm showing my age. Who's a hot basketball player now? What?
LeBron James.
LeBron James, sure. If you wanted to, you would pay a lot for an hour one-on-one with him, right, to teach you. You have all these shareholder letters from great investors available for free. There's a pretty good list on Morningstar. Oakmark writes great ones. Sequoia writes great ones. Tweedy writes pretty good ones. Wally White's writes okay ones. But that's a great way to widen that mental database, because you'll hear about lots of businesses, and you'll get kind of these quick little thumbnail sketches, and then you'll say, oh, gee, maybe I should read that annual report, or maybe I shouldn't, right? So widen the mental database, understand different investors, so that way you can, if you meet with someone, you can say, and they say, oh, who do you respect? What investors do you really, speak to you as an investor? Don't say the guy in Omaha. Please don't say the guy in Omaha. I'm serious, because the guy, your interviewer will just go, and also it means you haven't gotten out. It means you haven't kind of gotten out and done the work. It's a little bit like, who's your favorite baseball player? Babe Ruth. Even I know Babe Ruth, and I don't follow sports very much. Insight, companies, shareholder letters, and then the final thing is just have a passion for it. Somebody who's interviewing will know. They'll know whether this is what you live, breathe, and sleep, or whether it's just the job. And if it's just the job, that's okay, but you're probably not going to build a career in it, honestly. Because there are professions where it being just the job is fine. You punch in at 8:30, you punch out at 5, and everybody goes home and they live their life. Investing isn't like that. The successful investors, this is what gets us up in the morning. And so I mean, there are plenty of people at Morningstar who, they had the chops, they had the skill set, they didn't love it. Like I could tell this was just a job for them. And you know what? It means they're not going to bring something special to the table. They're not going to probably generate that flash of insight that really can help us. I don't know, that's a whole bunch of different stuff, but hopefully it kind of gets you thinking about it. But yeah, and also, I would just, last thing, network. I think I mean, this profession, I don't want to say it's unique because it's the only profession I know. People tend to be pretty generous with their time. I would say if you approach them respectfully and politely, and if you don't kind of assume that they owe you something. If you approach people and say, I'm really interested in learning more about how you invest, and you've done some work on them, right? You're not just sort of, it's a blunt thing, like, understanding like these purchases you made, like, and can I get half an hour of your time? And just network, most people will do that. Not everybody, but most people will. And it's an amazing way to learn. Most people will give you that time. And that's one of the best things about going to Omaha for Berkshire, is because you just can run into these people randomly and wind up with a 15-minute conversation that was worth more than any college course. He's gone, right? That was, no, that was, anyway, I'm joking. But I mean, something that was worth, more than any college course could be, because it was insight from someone who's been successful in this business over a 30, 40-year period. But that networking can be really hard, because you have to kind of put yourself out there and you're going to get rejections and no's and whatever. But I've seen a lot of people succeed really well in this profession because they started out networking. They started out just kind of talking to people, impressing them with their passion, with the sense of joy they have for what we do, and with kind of their knowledge. Because if you just sort of say, gee, I want to invest, and you don't know squat about it, it's not going to help very much. But if you've kind of done the homework, and you kind of had this foundation for an intelligent conversation, it can be pretty powerful. Yep.
What has been the most common trap that people have fallen into, or that even you've fallen into, when thinking it's a competitive advantage, but it's really not, and it's so that we can kind of keep an eye out for those?
Yeah. Certainly the hot product thing. I think a lot of people fall into that. Like, oh man, they've been taking lots of market share with this thing. Well, great. That's the past. Why will they keep doing that? And why can't someone else do the same thing to them next quarter, right? I think people confuse hot products a lot. I see that a lot in like stock pitches, that they've got this hot thing, and people are all excited about it. I think people get, then about investing, you were specific to competitive advantage. That's a big one. I think confusing market share with moat, that's another big one. People thinking that just because the company's the biggest or the leading, like what does the leading mean? I hate that phrase. If you've got 40% market share, but you're half as profitable as they have 10% market share, ask yourself what that scale is doing for you. So that's another one. Like market share, I think people really fall into that trap because CEOs like to yap about it a lot too, and they're incented to get bigger because big CEOs of big companies get paid more than CEOs of small companies. Sadly, that's a biggie. I think not looking at things from the customer's perspective. Like, why would the customer care about this new feature, this new product, this new thing that you have? Like, why is that good for them? Why does it help them value the product more highly and thus increase your ability to charge them more? And that's a hard one to do, right? Because especially in like the non-consumer business, where it's, a business-to-business thing, or you're part of the financial plumbing. Let's go back to the Moody's example. To understand why Moody's basically could lie to people and still generate a 40% operating margin, you had to understand how it was part of the financial plumbing, which means you basically would have had to talk to a whole bunch of people who buy bonds for a living. And they would have said, listen, without a Moody's rating, I can't buy this. By prospectus. But you wouldn't have known that until you got to them, right? You can't just kind of walk into the apparel store and start interviewing people. But I think that's the best analysts that I know and the best PMs, they always get into the customer's shoes. And I think that helped with Moody's, that helped you see where people were, the moat was there, but people were valuing it as if it wasn't. And then I think like that could have helped you see Motorola for that example. Like if you said to someone, okay, so someone has a better phone out next week that's thinner and lighter, would you get rid of your Motorola? Oh yeah. But now we just demonstrated, if Android came out with a phone, it was on the Android OS, and it had like 50% more battery life than than your iPhone, not everybody would switch. Some might. Anyway, but again, that's the customer, getting in the customer's shoes. Yep.
So once you think you've identified a company with a moat and you buy it, like you were talking about in your presentation, a lot of times the moats tend to be sort of this intangible thing, a little bit more sort of qualitative than quantitative. And if they're able to sustain that moat and continue having high returns on capital, how do you know when to sell it? Because if it tends to compound very well.
Yep. No. This is selling. Here's a dirty little secret of this business. Selling is a lot harder than buying. The really good buys scream to you. I mean, like in the first 10 minutes you look at something. I mean, you know it. Selling is a lot harder, and I would say that so a weakening of competitive advantage is one where you sort of like they have been raising prices and now they can't raise prices. A new competitor shows up and has an obviously sort of better product that's stealing share. I think this is somewhere where for us having a concentrated portfolio really helps because it's a discipline. And we say, okay, we're only going to own 10 to 15 stocks. And so if we find something that's better than our 14th best idea, okay, like that's it. We need to, bye-bye, and we put the new one in, which doesn't happen very often. But I think there is a danger with the truly wonderful business, of which there are a small minority, in trying to kind of move in and out of it based on valuation. Now again, things get egregious. I mean, you just gotta say, hey, thank you, Mr. Market, and say goodbye. But saying, oh, this thing's a bit, if you've done the work and you've identified a competitive advantage that you think is sustainable for somebody to find, and you've identified very high levels of reinvestment opportunity, and this thing moves up to 34 times earnings, or just pick a number that's a little bit high. Saying, oh, let's sell that and buy it back when it gets to 20 times earnings, that's the opportunity cost point, right? And so I would say that, again, it's a minority of businesses, but for the true compounders, waiting through periods of overvaluation makes more sense. You just kind of, because it's multiples expanded, you've probably gotten a few years of returns in a relatively short period of time. And so if it's kind of goes sideways or drifts downwards for a while, the world won't come to an end. Now, don't take this too far because, you can have something like, J&J got to low 40s times and, 01 or so and spent, 7 years going sideways. And that's because J&J is a very good business. It's never going to grow more than 6-7% a year. So, 40 times is just stupid. And when you get to stupid, get out. I don't know if that helps, but for the true compounder. But again, there's a minority of those. But I think the discipline of, this is where concentration really helps us and where I think it's important, is because you don't wind up with, let's put 2% in that. And you keep going. You're always having to force rank things. You're always having to say, is this a better idea than what we have right now? Because that commitment bias, we could do a whole talk on behavioral finance here, that commitment bias is very strong. It's very easy to keep, I've got a couple in my portfolio right now that I probably should have sold already. I screwed up on. It's very high. You want to look at everything with a fresh slate. Would I buy this today, again, right now? And if the answer is no, especially in a non-taxable account. Taxes are a whole different ball of wax. And most of our institutional money is not taxable. Why do you want it? If you wouldn't buy it again today with a brand new check that came in, brand new client, why do you want it? That's another way to think about the discipline.
Just a quick follow-up. For someone like you,
See, he's working on being an analyst. One more follow-up.
if you're only looking at companies that you believe have moats, so you're looking at a very select list.
Yes.
It's rather limited.
Yes.
So if something does rise to a certain valuation, and you have a list of companies that you believe have moats, and one of those all of a sudden looks
Cheaper. Yeah.
cheaper. Does it not make sense to switch them out?
Yeah, oh yeah.
As that continues to happen, and does that
Well,
make your
but-
turnover a little higher?
So you've raised a couple interesting things there. One is be very wary of false precision. It is much better to be approximately right than precisely wrong. And the other good quote, which is Sam Zell, which is, if it takes you to line 247 of your spreadsheet to figure out if it's a buy or a sell, you've already lost. You're dead. So trying to do what you're describing on the basis of not very significant valuation deltas, the odds you're right, maybe you're not, you know? It also depends, so let me take a step back. So some of this is linked to the compounding potential of the business. So we ran a strategy at Morningstar called Wide Moat Focus, which actually is an ETF, WMW, which you can pull up, and it's thrashed the S&P like 4 or 5 points a year. It's been awesome. But our universe was limited to wide moat stocks that Morningstar covered, which were mainly mega cap, mainly businesses that weren't growing very fast. And what we would do is, that was the universe, then take the 20 cheapest, put it in the portfolio, and then each quarter re-rank. And then, you know, and so that wound up for fairly high turnover, because there we were playing valuation arbitrage, right? All we were doing is making our money based on the convergence of price to value, because value was not growing very much. And so there we were getting a higher turnover, and I mean, it worked out pretty well. But if what you're looking for are businesses that are compounding a lot over time, most of your value is going to come from the growth of most of your return, rather, is going to come from the growth in intrinsic value, not the convergence of price and value. And so that's where that swapping, I think, can maybe, not dangerous, but I mean, that's where you may be getting a little too cute for your own good if you try to do too much of that. I don't think, one of you has not asked a question, or I think
So you said you own 13 stocks currently, so obviously that's not a huge amount of.
It's not a diversified portfolio, let's say.
But how do you size?
How do we size positions?
Positions?
Yeah,
Do you bet,
great question.
Do you have a couple stocks that make up a larger percentage of your portfolio? Do you bet big on your winners? Or
Yeah, that's an awesome question. And this is where sort of, you know, you're moving from being an analyst to being a portfolio manager, which is, you know, tricky. The way we do it, and there's no perfect way to skin this cat, so I mean, this is just how we do it. We want our largest positions to have the most optionality. That's how we think about it. So we own a company called MTU Aero, which is basically a parts supplier to jet engines. Most of their business comes from an engine called the V2500, which is on about half of all the A320s flying right now. They're kind of a captive Pratt & Whitney supplier, basically. It's a pretty knowable intrinsic value, because basically the way jet engine parts and engines work is you sell it at a loss, small loss, and then you make all your money on the spares. Spares are 38–40% margin. But you don't sell your first spare until the plane's been in the air for 7 or 8 years and parts wear out. Well, we know how many have been flying for 7 or 8 years. We know the age of the fleet. This is all data that's very available. And so you basically can get a feel for how many planes are likely to come in for service in this window, in this window, in this window, and there's your value, and you're kind of done. But there's not much optionality to that, right? Because even if, let's say Pratt & Whitney tomorrow announces a brand new jet engine that nobody had ever heard about before, which is not going to happen, because these things take 10 years to develop, and let's say MTU got on that platform, they wouldn't see a dime in profit for 7 more years. You see what I mean? So I mean, it's a very knowable fair value. There's very little option, and MTU just makes parts for jet engines. They can't go out and start an internet company. You know, they can't start the German eBay. So it is what it is. And so that's a 5% position. We bought it low, high 60s. It's 90 or something. It's done well for us. But like that's a 5% position. By contrast, our largest position is a company called XPO, which is about 12 or 13 now, I guess. Run by a serial entrepreneur named Brad Jacobs, who founded a firm called United Waste, sold it to Waste Management and killed it. Founded a firm called United Rentals, killed it with that. And so it's a repeat performance, which we love. You know, like okay, you've done this before. You're a higher odds bet than someone who's never done it before. And what XPO is doing is essentially rolling up the third-party logistics industry. So businesses that don't own trucks or planes, but basically match shippers and asset owners. That's all they're really doing. The business of moving stuff around the United States is really, really big. I mean, it's amazingly huge and amazingly fragmented. So their opportunity set is enormous. And so there's tons of optionality on the upside. So I want that big position, right? Silver Lake Access, which is the core banking software company at Singapore, that was a 5%. One of my analysts was in Singapore for a week last month and brought back some data that indicates that the market potential may be about 2 or 3x what we thought it was. And so now basically that's going to become a 10% position. Basically, again, optionality. I mean, they can grow 10, 12% off their existing user base, customer base, but half the banks in Southeast Asia haven't converted from legacy systems to new modern systems. It's there for the taking. So that's when we want big. So I think that's the way we think about it. It's sort of, when you have sort of that asymmetric upside, that's what I want. And there's all this opportunity out there. But when your opportunity set is very limited, like MTU Aero, that's a good stock. That's a good value position. It's going to do okay. But I don't want that as a huge position because I want to reserve that capital for the stuff that can really just, power the portfolio. But it's a great. Position sizing is tough. So it's a very good question, very good thing to think about. Yep.
You talked about airlines and how
it's the worst industry in the world. Yes.
Worst industry in the world. So what would be like the second, third, fourth?
Ooh, good one.
What are other industries?
Yeah. Auto parts. Awful. A couple small exceptions. There's a Swedish firm called Autoliv that makes safety systems. And there's a firm up in outside of Detroit that makes auto-dimming mirrors called Gentex, and they have most of the patents on them.
And what distinguishes them from the rest of the auto?
Well, because it was for Gentex patents. Basically, you know how your mirror has more and more stuff built in. First it's auto-dimming, and now you've got a cell phone built in there. You've got all this different stuff that's getting crammed into the mirror. They have a lot of patent protection on the auto-dimming technology, and so that's basically the moat. Is the patents. Other people have tried and they just can't, and I'm not an engineer, but I play one on TV. No. For reasons I can't remember, it's been very hard for others to replicate that technology. Part of it's the patents and there's other reasons. But they're the exception. Generally speaking, auto parts is horrible because you've got, you think about it, you've got a few large buyers, auto companies, and consumers buy based on cost, right? You're not going to pay 20% more for the exact same pickup just because it's got a certain brand on it. Even in Texas, I don't think so, right? Do you? People just don't pay giant premium for cars. And so your pricing power is up. So the auto manufacturer is constantly sort of beating on the parts supplier at a lower cost. Horrible industry. Anything commodity oriented, anything, mining, chemicals, oil and gas. I know I'm in Texas, sorry. Anything where you're a price taker, that's what you don't want. If you take price, basically the price at which you sell your good is set by someone who is not you. It's set by some global market and you have no control over it. How the heck are you ever going to make any money? That's just you can, but it's just really hard. What a headwind. Whereas if you're a price maker, where if you can basically set the price at which you sell your product, you are in control of your own destiny. That's so any business where you're a price taker, I would say is not worth your time. That's me. But I've chosen to sort of make my circle of competence competitive advantage. So those businesses just go whoosh. Now, if you really want to become an oil and gas expert and really get into the geology and the different places, look, oil and gas execs are some of the most loose-lipped people I've ever met. The Reg FD has never, ever met their, consciousness as far as I can tell. I'm serious. They'll let stuff slip. It's just like, how did you tell me this? So it's an industry where if you get really into the weeds, you can have informational advantages. You can know more about these companies than the average buyer of the stock. But you've got to really, really specialize, I think. It's just not what we've chosen. But I would say, price takers. Anybody who's a price taker.
What about insurance?
That's a terrible business too. generally speaking. Again, you're a price taker, right? I mean, you know, Geico cannot determine, I mean, Geico's a little bit different because they've got a cost advantage over others. But I mean, life insurance, do you really care who sells? I mean, if you want a 20-year term, you know, as long as the company's not going to go bankrupt next year, what do you care? I mean, this is what, you got internet sites that basically show you the cheapest quote. How can that be a good business? There's no way. And especially because the people pricing that risk, the insurance company, they're basically trying to determine when you will die, which means they're having to forecast medical technology 40 years out. I don't know, that sounds kind of hard to me. And unlikely like you're going to make a lot of money. P&C is pretty tough too. Re is tough. I mean, I see no competitive advantage. I mean, again, if you're Berkshire and you're like the one guy who, if the world falls apart, you can write the check Monday morning, you can extract some price out of people. Very few people are in that position. But life stinks. P&C is pretty tough because you just have insurance cycles, right? I mean, you know, premiums go up, more people enter the business, they write stupid policies, they lose money, right? It just, the cycle. I mean, specialty is not bad. I mean, Markel does some specialty, and that's okay. But specialty is also hard to scale. You know, I mean, you're sort of in these small little niche markets where you're the only guy with enough information to price risk properly. That's great. But then getting bigger? But generally speaking, I would say, I mean, and Buffett has said this too. I mean, he has said several times in letters, this is a really tough industry, and I don't know why you guys all spend so much time trying to learn about it. Insurance is tough. I have better uses for your time, probably, I would say. I've never found an insurance company I want. I mean, we spend a lot of time with this company called Admiral. Admiral's kind of like the Geico of the UK. I mean, awesome management. The shareholder letters just sing to you. Huge ownership, low-cost model. You know, they're based in Wales, and the people get paid like nothing. You know, I mean, it's just no. I mean, it's a cost advantage, right, relative to all the other UK guys. But the problem is, they're still in the auto insurance industry, and basically, when irrational competition shows up, writes a ton of policy and drives down price, they can't do a dang thing about that, right? They may, you know, their margins may get compressed less than everybody else because they had a lower cost base. That still hurts. Didn't really do much for me as a shareholder. So that kind of business where basically it's easy for irrational people to screw up your business, that's not a happy place to be. Because you're not in control of your own destiny. How much longer we got, Dave?
Time for one question.
Yes, sir.
We talked about how it's hard to find undervalued companies with a great moat. Where do you find your ideas at?
Turn over a lot of rocks. That's one of the biggest reasons I hired a couple new guys is just sourcing, turning over rocks. I would say that the things I would do kind of, you know, where you guys are, and we do this too. First of all, fish where the fish are. Right? If you want to catch fish, you don't fish in a dry stream. You go to a well-stocked pond. Maybe that's too easy. You go to a trout stream, maybe, I don't know. But the point is you don't fish in a dried-up pond. And so, you know, don't look in insurance. Don't look in oil and gas. Don't look in auto parts. You know, look in businesses with structurally good economics, data processing, payment processing, enterprise software. I mean, those kind of come to mind. You know, consumer brand, you know, durable consumer brands. Businesses that structurally make money, because some businesses are just better than others. I mean, no strategy book will ever tell you this, that some businesses are goats and some businesses are not. And this is the most frustrating thing I've found about like all the Michael Porter 5 Forces stuff, because all these guys, management gurus who write about strategy, they're trying to sell consulting gigs. That's how they make money. And if their very first page says, if you are in these 6 industries, you're just totally hosed, you're probably not going to call them for a consulting gig, right? You know, but the reality is some businesses are just easier to make money in than others. And so, you know, I listed a few of them. So you fish where the fish are. You know, I mean, don't assume you have a monopoly on brains. We don't. You know, we are not shy at all about looking at other people's portfolios. You know, people who have a similar mindset and a similar approach to what we have. And if I see something in the portfolio of a manager who I know is also quality oriented and thinks along the same lines we do, and I've never heard of it, well, either I'm an idiot and I should have heard of it, which happens a lot, you know, or they've just got a different opinion about the competitive characteristics, which is possible. You know, tomato, tomato, That's okay. You know, or we already own it, which is always great. But I mean, that's another way we look for ideas a lot. Sometimes it's just turning over rocks. I mean, so Silver Lake Access, the core banking software I mentioned earlier, I'll tell you exactly how I found that. I went through every stock in the Singapore Stock Exchange. It's not, which is not that many. It's not that, I mean, this is not the US, right? But basically, okay, first of all, very good rule of law. I mean, you know, Singapore, I mean, if you take a bribe, they pretty much cut your hand off. I mean, it's Singapore, you know, very little corruption in Singapore. So you can trust trust management, trust numbers. You know, IFRS standards. English is pretty widely spoken. Based in a region that's growing fairly quickly, you know, Asia. There ought to be something here we'd want to own, right? So just pull up the exchange. You know, just sort of went down company by company by company. You know, looked at margins, looked at returns on capital, looked at growth rates just to get a rough idea for things. A whole bunch of trading companies, some construction companies. You know, Keppel makes oil rigs. You know, just kind of keep on going down. Then I come across this software company called Silver Lake Access. And I was like, okay, that's interesting. Really good margins, good returns on capital, good growth. And the CEO owns 30% directly, which in Asia is really unusual. In Asia, management and founder ownership is often done through like a big series of holding companies. You usually have to untangle this big pyramid. He just owns the shares directly. Like that's not the kind of transparency I typically see in Asia. This is good. I mean, okay, what kind of software? Core banking software. That's a sticky business. I know that business. You know what I mean? So you just kind of keep peeling back the onion like that. I mean, sometimes you just got to do it that way. Just kind of keep peeling through. Or sometimes you get to know an industry, right? So the reason we own MTU Aero, this is the Pratt & Whitney aerospace jet engine company, we started looking at a company called TransDigm based in Cleveland. Amazing business, basically by small aftermarket parts companies. And aerospace parts are a great business because most of it's sole source. There's literally one company that makes the fuel pump and the lavatory door handles. It's all got to be FAA certified. I don't know why the lavatory door handle has to be FAA certified, but it does. And so TransDigm was a pretty good business, but pretty levered, pretty promotional CEO, gotten pretty big. We weren't sure how much more runway the acquisition program had for them. But it forced us to learn the aerospace aftermarket industry. And so by learning that, we figured, you know, we sort of ran into MTU and other companies. So that mapping out a value chain often really helps. If you find one good company in an industry, if it's like the one good company in a really crappy industry, that's okay, but it's probably not, the structural economics probably aren't good. But if it's in a structurally great industry, just keep following the value chain and get to know everybody in that industry. Probably easier too.
Why don't we give Pat a big round of applause?
Thanks, guys.
Pat, thank you very much.
No, thanks for having me. Appreciate it.
And in honor of your trip here, limited edition collector's item, Bulldog Investment Company collector T-shirt.
Oh, awesome.
Can't find them anywhere.
Awesome. Love it.
Very wide moat on those.
Love it, love it, love it.
In honor of your trip here.
You're sure it's not just a hot product?
I'm very sure. Pretty sure. And also, in honor of your trip here today, and out of respect for your time and your intellect, top-performing students in our program next semester are going to receive the Pat Dorsey Scholarship. So
wow,
thank you very
cool.
much for your
Sure,
time.
You bet, no problem.
We very much appreciate it.
Happy to be here. Happy to be here. Stay in touch, gang. You know, this is there are very few professions like this where you basically get to stretch your mind every day and, you know, learn about a new industry, a new company, and then see if you're wrong or right, because the market will tell you.
For more information, please visit tlu.edu.